Last week, Microsoft experienced an interesting situation. Their Teams and Outlook services were down for over 24 hours, yet their stock still rose by more than 2%. Does this mean it's time to consider buying Microsoft shares? First, let's understand what we're dealing with. Microsoft Teams and Outlook are part of Microsoft 365, a suite of services that millions of companies worldwide rely on. To put this in perspective, Teams alone has a staggering 320 million monthly users, as you would expect for a tech giant. Microsoft and Nvidia seem to be in this endless, ever-changing battle for the top spot as the world's most valuable companies. It is now a race to $4 trillion in market cap. This kind of market cap isn't just a number. It represents the immense trust and value that investors see in Microsoft's future, and likely why the stock rose 2% despite the power outage. But the bigger picture puts the 2% surge in context. Microsoft has been trading in what I call a consolidation within a consolidation, stuck between July's high and August's low. Now, while the 2% rise did push the stock back above the daily 200 simple moving average, which is typically a bullish signal, we need to look at why Microsoft has been moving sideways for about 5 months. This pattern formation is crucial for understanding where the stock might head next. From a technical analysis perspective, it's actually quite logical. Since its 2022 low, Microsoft has climbed an impressive 120%. And here's something crucial to understand. After every significant move in the market, a stock needs to take a breather. This sideways movement or consolidation is perfectly natural market behavior. The stock corrected about 18% and has been consolidating around that 200-day simple moving average, which makes perfect sense. Think of it like a marathon runner dropping to a more restful pace after completing a challenging stretch. It's not a sign of weakness, but rather a preparation for the next leg of the journey. Now, during these corrections, something predictable happens. The internet explodes with market crash predictions. Every influencer and analyst tries to call a market top, despite countless failed attempts since the longest bull run in history began back in 2009. I've seen this pattern repeat itself countless times, and it's always the same story. Fear-mongering gets clicks and views, but it rarely helps investors make sound decisions. But here's my question to you. Do you want to buy into sensational headlines, or do you want to buy into a strong stock at the right time? Back in July and August, during big tech's challenging earnings window, everyone was screaming market crash. While Microsoft fell about 18% during this period, I told my investing community to stay patient. Why? Because this looked like a correction and base formation. Exactly what we've seen play out. This kind of pattern recognition comes from years of market observation and understanding that corrections are opportunities, not catastrophes. While big tech's weight dragged down the major indices during that July and August correction, smaller weighted stocks like Fiserv and Walmart kept pushing to record highs. This perfectly illustrates why having a systematic approach to reading the market as a whole is so crucial. It's not just about following the big names, it's about understanding market dynamics and how different sectors and stocks interact with each other. From a fundamental perspective, several factors have contributed to this sideways movement. There's been some investor caution over Microsoft's substantial AI investments, which is understandable given the significant capital expenditure involved. The company is also facing increased regulatory scrutiny, a common challenge for tech giants these days. Additionally, we've seen a market rotation away from mega cap tech stocks as investors explore opportunities in other sectors. But as already mentioned, these temporary headwinds often create the perfect setup for the next major move up. Looking ahead, Microsoft has some powerful catalysts that could drive another significant uptrend. Their expanding AI and cloud services aren't just buzzwords. They're real revenue generators with massive growth potential. The upcoming Windows Server 2025 release is positioned to capture a larger share of the enterprise market, and their enhanced data center infrastructure could give them a significant competitive advantage. The company's strategy of pursuing strategic acquisitions and partnerships has historically been very successful, and there's no reason to believe this won't continue. What's particularly exciting about Microsoft's future prospects is their commitment to integrating AI capabilities across their entire product suite. Starting in early 2025, they're planning to roll out new AI features and agents for their 365 Copilot ecosystem. This isn't just an incremental improvement, it's a fundamental enhancement of their core products that could drive substantial revenue growth. So what's the smart play here for you and me when it comes to buying the stock, either for the first time or maybe more of it like we are looking to do? We've been holding Microsoft since the start of the year. You've got three options, so let's go through each one. First, you could buy in now and potentially catch the entire next uptrend. The advantage here is obvious. You're positioning yourself at what could be the bottom of this consolidation phase, meaning maximum returns if you catch the whole move up. However, you need to accept the risk of further sideways movement or even a drop towards the $300 level. The second option is to wait for confirmation with a break above September's high. This is a more conservative approach that still gives you plenty of upside potential. The main risk here is that the stock could reverse back into the smaller consolidation or face resistance at the current all-time high. You might need to be patient as the stock works through these technical levels. My preferred approach is to wait for a complete breakout from this consolidation. Let the stock set new record highs and confirm the start of the next uptrend. I could potentially even wait until it clears $500. Then ride the trend up towards $1,000 through 2025. Yes, you might miss some initial gains, but you make up for it through strategic compounding, which is adding more shares as the uptrend develops. This approach combines technical confirmation with fundamental strength, reducing the risk of false breakouts while maximizing profit potential. But here's what people often miss. While waiting for Microsoft to set up, I'm not sitting idle. My portfolio already includes several other exceptionally performing stocks that are doing better than Microsoft, like Fiserv and Amphenol, and I'm constantly looking for new opportunities broken out from consolidation and started their next uptrend. Stocks like Visa, which I've recently added more of into my portfolio. Palantir has seen significant growth, rising nearly 300% in 2024 and may just be at the beginning of a major long-term trend. Watch this video to find out if the stock is likely to continue climbing, especially now that Bank of America has raised its price target to $75.